Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading reports for April 29th, 2017. The market is in bullish normal conditions. On an annual basis, using weekly RSI 14, it is at the higher end of neutral at 69 out of 100. On a 10-day basis, using the 10-day NDX, we are very nearly overbought at 79 out of 100. 80 is the threshold to overbought. Looking at the market mosaic, price with respect to the 200-day moving average is 7.16% white bullish, so we're 5% above sideways markets. Slope of the 50 improves slightly, but remains yellow neutral at positive 0.28. ADX strengthens slightly to 17.7, but remains neutral with respect to trend strength. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off on that indicator. It currently reads 1.14, so we are into risk on conditions, meaning that riskier assets, growth assets, are now favored. By taking that score of 1.04, 1.04, and looking back 5,000 trading days, we find the average and standard deviation of that indicator to find the risk Z, or the Z score of that indicator. It reads at 0.36. This is a 90-day histogram of that indicator. You can see that we've come from a minus 1.5 up the slope now over the last 5 days to a positive 0.36. This turning point here, when it dips below minus 1 and then starts to dip up, we get signals that it's time to begin long side swing trading in growth assets, and that has been paying off. The blended monthly rebalancing holdings for this month for the three portfolios, and then the current leaders based on closing prices Friday. We'll be looking at the monthly rebalancing update next week, and those are the leading candidates. ETF2 model is at 100% exposed, and the model portfolio is also at 100% exposed. These are the blended monthly rebalancing portfolios, and you can see everything is on a buy signal except in the ETF32, the financial spiders. Technology, emerging markets, and the Dow leading the way, and the Dow's had a nice rebound here. ETF Max uses the same discipline to look at 1,000 ETFs, and as I've said before, what I like to look at not only are who the leaders in the clubhouse for the blended, but I also use this as a way to guide some shorter term turbo trades using the leaders. And what I look for on those are exceptional conditions for either follow-through gains or losses since last week. And you can see last week's, what I've left on here is last week's order, but with current updates. And so ECH, which was chilly last year, which was in the number one position, has lost significantly this week. And whereas EWO, which was in 6th position, is now in 15th position, but it had a terrific follow-through. You can see that Chile dropped 100 slots. So the ones that are in green highlights in the 1 week and 1 month, those are ones that have had an exceptional performance compared to the ones in the ETF Max database. And the ones that are in red have exceptional underperformance. And you can see by the numerous green and red indicators there that it is a normal thing for exceptionally strong positions to have large follow-throughs either for good or bad in the following week. And so that becomes a fertile place for large short moves, which is a trader's paradise. So that's how I use the blended monthly rebalancing as a way to find candidates that make interesting trades. Now, what I'll do is go through these and then subject that to the swing trading discipline of framing the trade, computing reward to risk, evaluating the RLCO patterns against it, and so forth. But this is a place to quickly narrow a search for interesting topics. Same thing with the S&P 500. You'll notice some amazing follow-throughs this week. You know that if the holders of BCR just experienced a 21% gain this week, that they're going to be making some emotional decisions about that symbol. And those who didn't own that symbol will see that and say that's something of interest. So my expectation is that bulls and bears both will be flocking to that symbol more so than is normal for that symbol, and then looking to trade shorter term off that news. And so that's why it becomes a candidate of interest for me. The RLCO frameworks allow us to calibrate the kinds of moves that happen under emotional conditions, and the different patterns of the first and second generation give us ways to trade favorable moments in that curve. So things like BCR, Western Digital, Royal Caribbean, Wynn Resorts, how awesome is that? That's one of our standard trading symbols anyway for swing and intraday, so me gusta. Quick look at the market health check. The vertical blue lines are 10, 20, and 30 days of look back, and there's 60 days. The horizontal red lines are support levels that have held. They were once resistance levels, and now they're support levels, like this one at 234 at the belly of the dragon, and the double bottom of the dragon held nicely. It was also coinciding with the channeling signal, which mechanically captures that move. The 10-period regression line sloping up, but priced right at about the 50-yard line, or actually in the bottom half of that. The 30-period regression line channel sloping slightly upwards, with price near the top of that, finding resistance near all-time highs at 239. If this fails, a move of this magnitude back to the red line is certainly within normal. It keeps it within the floodplain. So our first target on the downside would be about 235. If the dragon doesn't hold, then it would be the red line at 233.5. The floodplain 232.5, and then the last gasp down here at the Z3 at 230. Were that to fail, see these other red lines are the step ladder of prices on the way down, and now you can see the 200-day moving average creeping back into the picture. This sine wave looking thing right here is the moving regression line slope value. You can see red line or red dots are places where it bottomed out. Blue dots are where it crossed the zero line, as based on the left side index. Green dot was the swing high of that slope value. This one was at 0.44. This, anything above 0.40 is an exceptional move, or an exceptional slope. So this was actually quite a substantial and remarkable move. And then when that rolls over, you can see that the regime goes from steady gains to sideways chop in a few tests until that slope value comes all the way back to the zero line. And on this day is where the slope of the 30 got flat and then went negative as it still kept some of these highs and began sloping downward. It only got as low as the red dot, or minus 0.09, which is only halfway to the significant downward slope measurement of 0.22. So upside 0.4, downside minus 0.22, and those come from a 5,000-day look back of all of those slope values of the S&P to give us a sense of what is a normal up or down slope. I just want you to notice this section in here between day 30 and 60 as what we call an unambiguous move, because you can see that the price and the baby dragon have gotten completely out of the river, excuse me. and the river is clean. That marks it off as an unambiguous move, whereas you can see, we think of that as being muddy or congested in the middle of Crocodile River where you get chewed up. So after this decline of slope to the red dot, it began to improve, crossed the zero line here on this, upward move, and now is currently rising and is at minus 0.04. So that upward slope is just beginning. As you can see, it's practically flat, but it is tilting up, and that's a favorable sign going forward. The jaws of PPO are open to the upside, and that's favorable. It said the ETF2 world market or index model. All the ETFs, all the indices are on a buy signal compared to their moving average. So that leaves us at 100% invested, 0% cash in the theoretical allocation. EFA at 67 is stronger than the S&P at 63, so the globals are in better posture right now than the S&P, than the U.S. Inside the U.S., the strength is in mid caps, then the large caps, then small caps, then tech. Japan and the Euro-Asia mix are the two strongest sectors. Asia less Japan and the European 350 in the red here are those are the two weakest sectors. Inside the sector spiders, see everything above average with the exception of energy, which is still getting smashed. Technology is probably the next best thing, along with healthcare. So healthcare may be making a comeback after about 6 months of just getting savaged. This is the market health check looked at through the ETF2 lens. Starting with the U.S., everything above average except the Dow, lagging a little bit. Now, it's lagging in this system view. It was near the top of the BMR. Part of that has to do with the different methodologies used to compute relative strength, and so there can be some differences and divergences that just lead us to examining the charts more carefully as a way to double check our judgment. Japan above average, Asia less Japan very weak, but with isolated pockets of strength like Australia, Malaysia, Taiwan. In Europe, several countries are standing out. Bonds starting to do well, and gold and silver beginning to give back. Western Hemisphere and the emerging markets looking pretty good. Looked at through the lens of the ETF 30 database. Those that are in green and green on strength and consistency are exceptionally above average. You can see all the definitions of the colors here. So green and white signifies something that just became super strong, but has been above average in strength. So that's an emerging leader like Taiwan, T-bills, Australia, home builders. Looking at the Dow through the same lens, the strength leaders have been American Express and Intel, United Health and Microsoft, joined by Walmart, which used to be at the bottom of the stack several months ago and has worked its way back up. This weakness in Coke is kind of remarkable, where it's green on consistency but yellow in strength. That shows a recent plunge in relative strength, and that's one that I'll investigate to see if there is an opportunity to buy Coca-Cola on sale, on value. To a lesser extent, Boeing, you'll notice, is yellow and white, so that's a divergence to the weak side. Then the four weakest symbols: ExxonMobil, Verizon, Goldman, and Disney. Goldman used to be at the very top of this. This chart looks at the liquidity of the largest indexes, the ones that trade the largest daily dollar value based on the average of the last 30 days, number of shares times the price. and then shows you the relative ATR percentages that they have, and the ones in the green that are exceptionally volatile compared to their peer group, and thus make very useful intraday trades. So like EEM, financials and gold miners, the VXX, XOP for oil and gas, Brazil, and regional banks. Shifting now to the daily report, we have a handful of mechanical signals firing in real estate's Procter & Gamble, Silver, General Electric, Treasuries, and quite a few still in the auto framer to choose from. You can see the breakdowns here on auto framer reward to risk ratios, and just a few in the Dow that work. General Electric has a 2 on RSI2, 4-to-1 reward to risk. It's a 5-day down, and had a doji on Friday. That's in the wheelhouse. Despite energy being a lagging sector, Chevron was a percentage winner on Friday. There may be some more follow through on that one. And then you can see the ones firing better than 3-to-1 on the frog quality number. Looking at the ETFs, only a handful of signals, but real estate single digit in the RSI2. It was a percent loser on Friday. And even though it was a loser, it still hits the 551 criteria as well as channeling, and offers 2-to-1 reward to risk ratio, also worth looking at. For those building mechanical trade frames for the auto framer, these are swing trade frames that are meeting our 2-to-1 reward to risk ratio on a mechanical price location basis with respect to the last 10 trading days, and taking into account the previous day's range. And then the regression line fractal framework, these are ones that in the top shelf are deep value plays because they are the most numbers of ATRs below their RL270. These in the red on the bottom shelf, the ones that are the most above their own RL270, so these will be relative strength leaders. You can see Walmart and Coke are both above. Walmart has moved from the bottom of the stack all the way to the top of the Dow in terms of relative strength, and Coke was once a high flyer and then had that sharp pullback. It's yellow and white, yellow and green, excuse me. So that's one that will bear some scrutiny in our follow-up preparations. The daily squeezes are ones that have had large average daily ranges, but which were squeezed very tight on a relative basis on the last day of trading, and so it's like a compression play that normally moves much larger. We can think of the spring now being compressed and is ready to expand. These become one-day pops, which, if there's follow-through, can grow into becoming swing trades. So this is where a daily frame, its relative price condition can lead to shorter-term swing trades. And we're looking at EFA, which is nice because that's the strength leader in the indexes. Both of the volatility ETFs, healthcare, the Dow Jones itself, that's favorable. That means if there's an upside pop in SPY and DIA, then that's one we should pile on and start riding that momentum short term to the upside. In the market mosaic, just to point out that the slope of the 30 recently went back above the zero line here, but the early indication of the crossover over the 10-day moving average of that, which occurred one standard deviation below the long-term average, this little move right in here signaled a turning point, that this is the place where it would have normally failed in order to stay true to the previous 30-day trend, but it didn't. It gave us a signal up, and even though there was a little pullback, the strength of that follow-through caused the polynomial regression line to roll up, gave us a favorable indication, and then this was a change in condition at a significant distance from average, so that marks it as a potential turning point. I like the fact that it had a low and a higher low as well. And now you can see on the longer term 180-day chart that when those turnarounds occur outside of one standard deviation below, you can get small bumps or really extraordinary moves here. This was a 15% move off the bottom. And then these turning points on the top side, the regime went from growth to sideways chop. It went from growth to outright failure. And this is why we place stops below resistance to protect against subsequent follow-throughs. And now this little upward tick is the beginning of a move that is in the middle of resistance, but could move another 8% to the upside. So we are cautiously optimistic here. The slope compared to the last 10 years is right in the middle of the long-term average, so there's no overheating or underheating here. This is right in the normal market chop, and again, just beginning to make the move compared to the long-term indications. Volatility had been exceptional, beginning to pull back into normal. That's also favorable for the upside. I'll flash through the statistics for the intraday calibrations. You can stop that at your leisure. In the swing z-scores, I'll be talking about this on the prep videos that I am making for the advanced swing participants for Raleigh next week. But in this case, when you see it go from yellow to white, what that means is that in the shorter term holdings are starting to outperform their historical performances, whereas it is underperforming over 40 days. It's now beginning to outperform over 5 days. And what that says is that there's some short-term momentum coming into things like EFA. Now notice that was the strongest sector that we've seen. It's above average on all of those time frames, so that would explain its outperformance compared to the S&P. And technology is beginning to turn the corner, as is emerging markets. Energy lagging across the board, but less so lately, so that makes things like we saw with Chevron and ExxonMobil as legitimate opportunities to get in early to the reversals. The strength in Microsoft is attractive, along with the strength in technology. That should be on our short-term list. So when you see the market beginning to turn on the 10-day and 5-day, and technology leading the way, and Microsoft leading the way, that's a logic chain right there that gets you to Microsoft as a high payoff potential signal. In the slopes of the regression lines, we talked about this being a sweet spot last week, and with the 30 bottoming out and starting to roll up, and then the 10 making a low and a higher low is well postured, and the 90 has come back and cooled off into the normal channel, so it's no longer dramatically great. It's had a cooling off period. A base has been established. That's the argument for support at this level. Bounced off the southern skin of the river, or the southern bank of the river, I should say, and now the dragon has peeked out of the channel, and up we go. And that's everything I wanted to cover. I'll just flash through these other ones for you in case you want to look at them. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.